Welcome to Koffee Chats with Klaas. Hi, I'm Alyssa Ebert with Klaas Financial, and today I'm here with Nate Bribey, a certified financial planner, to learn about how our taxing system works with regards to income and growth of our investments. Nate, can you help explain the income tax system as it exists today?
Sure. The passing of the Revenue Act of 1913 gave Congress the power to lay and collect taxes on income. Since then, hundreds of changes to the income tax code have been made. What exists today is a progressive tax system that taxes income at different rates depending on how it is received. As income rises, higher taxes are applied. The two basic types of income an individual can receive are ordinary income and capital gains income. Currently, ordinary income can be taxed at 7 different brackets: 10, 12, 22, 24, 32, 35, and 37%. Whereas capital gains income can be taxed at 0, 15, or 20%.
How does someone determine what tax they'll pay?
Taxpayers start by determining their total income, which includes all forms of income, including wages, salary, bonuses, interest, dividends, pensions, capital gains, etc. From there, any adjustments are made to income listed on Schedule 1. This could include additions or subtractions, such as stock options, business income from Schedule C, HSA deductions, SEP/simple contributions, and so forth. Schedule 1 deductions are commonly referred to as above-the-line deductions, as they happen before AGI is calculated. Total income plus or minus any adjustments on Schedule 1 will provide you your adjusted gross income, AGI. AGI is important for determining eligibility for various tax credits or deductions. And finally, a standard or itemized deduction will be reduced from your AGI to determine your taxable income.
How do you know if you will take the standard deduction or itemize?
This can be a moving target from year to year. By far, most taxpayers will take the standard deduction, which in 2024 is $14,600 for individual filers, $29,200 for married filing joint, with an additional deduction of $1,550 for each taxpayer over 65. In order to itemize your deductions, they must exceed your respective standard deduction.
Now that we know how taxable income is determined, which sources of income get applied to the different brackets?
Taxable income is separated into ordinary income and capital gains income. Ordinary income is most forms of compensation reported on a W-2 from your employer, including bonuses. Contrary to popular belief, bonuses are not taxed at a higher rate than other forms of compensation. Your employer just generally withholds more taxes. Other forms of ordinary income include pre-tax retirement account distributions, 401k, 403b, IRA, etc. Pensions, ordinary dividends, interest, short-term capital gains, any taxable portion of Social Security, and some forms of annuity distribution, amongst others. Long-term capital gains are gains that are realized after holding an asset for more than 1 year. Short-term capital gains are gains that are realized within 1 year of purchase. Any realized capital losses are netted first from any realized gains. If losses in the calendar year exceed gains, up to $3,000 can be used to reduce ordinary income. Any unused loss can be carried forward to future years. And finally, gains or losses in retirement accounts or annuities are deferred and are not taxed.
How does someone know what tax bracket they will be in?
This is where the progressive tax system comes into play. Generally, not all your income is taxed in the same bracket. For example, a married filing joint couple who has $100,000 of taxable ordinary income in 2024 would pay 10% on the first $23,200, 12% on the next $71,100, with the final $5,700 being taxed at 22%. This would result in a total tax of $12,103. Taking total tax divided by taxable income would give an average rate of 12.1%, far below their highest marginal bracket of 22%.
And what about long-term capital gains?
The same progressive tax system applies to capital gains brackets as marginal brackets. Any long-term capital gains will be stacked on top of any ordinary taxable income. If a married filing joint couple has taxable income of $94,050 or less, these gains are taxed at 0%. If taxable income is between $94,050 and $583,750, long-term capital gains are taxed at 15%. If taxable income exceeds $583,750, long-term capital gains are taxed at 20%. Net investment income tax may apply as well if your modified AGI exceeds $250,000 for a married filing joint couple. It is important to note that the Internal Revenue Code is not simple, and the tax code is written in pencil, not pen. Seeking professional guidance from a qualified accountant or CPA is recommended.
Thank you, Nate. Great information. And thank you for joining us for Coffee Chats with Klaas.